Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, June 14th, 2024. 2 days ago, the Federal Open Market Committee announced that it decided to maintain the target rate for the federal funds rate at 5.25% to 5.5%. It further noted that it does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. The final sentence of that paragraph ended with this unambiguous statement: the committee is strongly committed to returning inflation to its 2% objective. So, I included a link to the statement here in the body of this article, and you can see it here on the screen. And there is no misunderstanding the meaning I'll highlight for you right here of that statement. In other words, they're really looking for more data to show that inflation hasn't leveled off. That probably won't happen anytime soon. The day before the FOMC issued its statement, we learned that the Consumer Price Index was flat in May and increased 3.3% over the previous 12 months. So here is that press release, and over here in the far right column is the unadjusted 12 months ended through May. And you can see up here in the top line, 3.3%. Excluding food and energy, those numbers were 0.2% and 3.4% respectively. My guess is the FOMC won't even consider a rate cut until the annual growth rate for inflation falls below 3%. And even that would depend on other data regarding consumer spending and employment. Now, I closed last week's update by opining that given last month's rise in the unemployment rate to 4%, perhaps the Fed doesn't need to do anything at all for retail spending to slow down on its own. It looks like it may already be underway. This week, Bank of America issued a report that observed consumer spending momentum continues to appear soft but stable. Also, Gen Z and younger millennials' share of spending on discretionary items is declining, potentially due to increasing spending commitments as they get older. So here, again, I included a link to the report, and there are those bullet points right there. In other words, younger consumers are beginning to feel the effects of higher interest rates on home purchases and other big-ticket items. The report concludes, to counter these pressures, we find some evidence that the younger generations are trading down in grocery shopping and restaurant decisions. That is precisely the type of financial decision making that the FOMC has been trying to induce for the past 2 years to slow down inflation. Now, so far, Wall Street has responded by moving money into what it regards as the safest place in the stock market, namely mega-cap tech stocks. During the past month, the cap-weighted SPDR S&P 500 ETF Trust, or SPY, has gained about 4%, while the Invesco S&P 500 Equal Weight ETF, symbol RSP, is down nearly 1%. So now here's the SPY, and this is year to date, and you can see, it had this drop down in April, but it just hit an all-time high this week. Clearly an upward momentum, but if we go to, the S&P 500 on an equal weight basis, the chart peaks back here in March, and then if you look way over here on the right, it actually, has been dropping down. So here is where I think it's clear that Wall Street is pulling money out of, and even the S&P 500 is a large cap stock index, but it's really the so-called Magnificent Seven and other mega cap stocks that they're really putting their money into. Now, the good news is that if Wall Street, Wall Street is not abandoning the stock market altogether. If it were, then both the RSP and SPY would be falling. The bad news is that this trend will most likely remain in place until a rate cut appears imminent. Until then, it will be difficult for all but the largest companies to make much headway in the stock market. So that's this week's update, and I look forward to talking to you in another week. Thank you.